Social media has become a powerful force in shaping our culture, behavior, and preferences. It has also influenced our spending habits, especially when it comes to buying cars. Many people use social media platforms like Instagram, Facebook, and TikTok to showcase their lifestyles, including their vehicles. They want to impress their followers and friends with expensive cars that reflect their status, taste, and personality. However, this desire to keep up with the Joneses online can have serious financial consequences. Many people who buy cars for social media purposes cannot afford them and end up taking out risky auto loans that they struggle to repay. This can lead to defaulting on their loans, losing their cars, damaging their credit, and facing legal action from their lenders. According to data from Experian, more than 26% of auto loans are issued to subprime borrowers who have credit scores below 670 and are more likely to default on their payments. The average interest rate for new car loans was 6.27% as of February 2023, while the average rate for used car loans was 10.26%. The average loan balance was nearly $30,000 last year, and the average monthly payment was $700 for a new car and $525 for a used car. These high costs and heavy debt burdens have put many borrowers under financial stress, especially amid the economic challenges caused by the COVID-19 pandemic and the rising inflation. According to data from the New York Fed, 90-day delinquency rates on auto loans peaked at 5.3% in the fourth quarter of 2010 and dropped to 3.9% as of the third quarter of 2022. However, this rate is still higher than the long-term average of 3.46%, and it is expected to increase further as more borrowers fall behind on their payments. One of the factors that contributes to this problem is negative equity trading. This is when borrowers who owe more on their car loans than their cars are worth trade in their vehicles for new ones and roll over their remaining debt into a new loan. This creates a cycle of debt that is hard to break and increases the risk of default and repossession. According to data from Edmunds.com, about one-third of car buyers who trade in their vehicles have negative equity averaging $5,000. This means they start their new loans with an extra $5,000 in debt on top of the price of their new car. This also means they pay more interest over time and have less equity in their new car. The auto loan market in the U.S. has been growing rapidly in the past decade, reaching a record high of $1.52 trillion in outstanding debt as of the third quarter of 2022. However, this growth has been fueled by risky lending practices, high interest rates, and low credit standards, creating a potential bubble that could burst and trigger a financial crisis. If a large number of borrowers default on their auto loans and lenders repossess and sell their cars at a loss, this could have a negative impact on the broader economy and financial system. It could reduce consumer spending and confidence, lower vehicle demand and prices, increase inventory and supply chain disruptions, impair asset-backed securities and collateralized loan obligations, and expose banks and other financial institutions to losses and liquidity risks. Therefore, it is important for both borrowers and lenders to take proactive measures to prevent or mitigate a potential auto loan default crisis. Borrowers should be more responsible and realistic about their car purchases and avoid buying cars they cannot afford or do not need for social media purposes. They should also contact their lenders as soon as possible if they are struggling to make their payments and try to negotiate a solution that can lower their interest rate, extend their loan term, defer or forbear their payments, or modify their loan terms. Borrowers should also seek credit counseling from reputable nonprofit organizations that can help them manage their debt and budget more effectively. Lenders should also be more responsible and prudent in their lending practices and avoid issuing loans to borrowers who cannot afford them or who have poor credit histories. Lenders should also monitor their loan portfolios closely and identify any signs of distress or delinquency among their borrowers. Lenders should also be flexible and cooperative with their borrowers who are facing financial difficulties and offer them reasonable options to avoid defaulting on their loans. By taking these steps, both borrowers and lenders can reduce the risk of an auto loan default bubble bursting and causing panic in our financial markets.